Hi, and welcome to the May 2012 Strategic Market Update. Here are my key takeaways. The U.S. economy continues to slow, as do corporate earnings. Jobs, however, are continuing to improve. That's positive, but a lot of that has to do with people leaving the workplace and retiring more so than new jobs being created. Our overall personal savings rate dropped again to 3.7 last month. That would be negative. Inventory, though, is still dropping, and that's a positive. Valuation still declining, and that is a negative. Overall, a bottom is forming, but it's weak. We've got a lot of mixed positives and negatives. It's looking like most of 2012 will be needed to carve out this really sound floor. Some markets are better than others. Population growth is critical to a market where housing needs to improve. If people are moving into the area, it's a vital area. You can still have positive housing appreciation. Overall, Washington's working hard prior to the elections to stimulate housing, ramping up additional HARP guidelines, as well as looking to stimulate the economy, continuing to buy bonds to keep those interest rates low. So overall, again, we've got a positive base, but it's going to take time. Let's take a look at some of the specifics. Where are we now? We look at the market as a whole, that point of maximum financial risk. We look at that right now in terms of the market. We've kind of drifted a little bit further down towards anxiety as we look at both problems in Europe, Greece, and Spain. Overall housing, not too much in the change category there, still hoping that things will improve. But the big indicator that's visual to most consumers is their house prices are continuing to go down instead of up, and that really affects confidence. Here's a wonderful U.S. housing summary in a single page from John Burns. Take some time, hit the pause button, and study this. About 22% of Americans now own their home with no mortgage. 34% of Americans own their home and have some equity in it. And 34% of Americans are renting. So we've got about 90% of Americans covered there. The remainder, if we look at the ones that are renting, there are about 40 million consumers who rent. About 42% are renting a small apartment, 27% are renting a single-family home, 20% are renting in larger apartment buildings, and you got 11% either in a condo, a mobile home, a boat. But overall, you can see a breakout here of the total housing units of around 133 million units and how they flow. So let's get into the overall general market update. What's happening at the big picture? New home sales dropped a little bit, adjusted to 328,000 last month, down from an expected 353,000. New home inventory continues to drop. A record low 48,000 new homes were for sale in March. So again, this is very positive because as inventory stays low, it starts new building. It also helps prices to creep up. Months of supply continuing to drop for new homes. We're at 5.3 months of inventory. That critical 6-month level there that we've talked about before. When housing is under 6 months of inventory, that's positive for house prices. When we get down below that into the 5.3 and lower, that continues to put positive pressure. The concern will be shadow inventory. Does this start encouraging banks to list the 5 to 6 months of shadow inventory they have on their books, which would again increase inventory and further put pressure on housing prices. So here's one way to look at the impact of that lower inventory, the Trulia Price Monitor. This is a new seasonally adjusted price monitor that looks at the average change in house prices on a month-over-month basis based on the asking prices to look at are consumers selling their home getting more or less than their asking price, and we can see that is trending up, hitting a 1.5 or 1.4% higher in March than a quarter ago. This is a positive sign that people are starting to get more of what they're asking for on their prices. On a year-over-year basis, some of the top MSAs are still negative, but we can start to see pockets of green. Areas like Florida that were hard hit, Nevada, we're starting to see more of an increase in prices there. They also went down the furthest. But we have headwinds. Here's a wonderful graph from Calculated Risk that looks at the impact of MI deductibility. So if you look at an overall typical FHA buyer who's putting down less than 5%, and you look at the increase in the monthly and the UFMI premiums, it's going to cost them about an extra $24 per month. But MI deductibility also ended at the end of 2011. So if you add that, it's going to have a negative impact on the cost of home ownership. You take a $200,000 fixed rate mortgage at 4%, and you take away that ability to deduct the MIP as well as the monthly change, you're talking about a $54 a month extra cost for that home buyer. You get up to a $400,000 home with MI, and you're talking about close to $155 per month increase. So you can see here, if they're getting FHA financing using an MIP or UFMIP, you see the increase there. And then in the red, when you look at the loss of deduction for someone getting a conventional loan or someone getting FHA and conventional, you can see how this starts to add up. $78 roughly, $74 on the $200,000, $400,000 on the loss deduction. We see a phase out though, because over $400,000 with the income phase out, you most likely wouldn't have gotten much of a deduction anyway if you were buying a larger home, but that could still affect you up to the maximum FHA limit. So overall, what could happen is someone who bought a house in 2008, 9, or 10 that's thinking about buying a new house, the cost of that same house has gone up for them, and that will be a drag on housing. We still have what was called by the calculated risk the distressing gap. This distressing gap here is this big difference between new home sales and existing home sales. Why? Builders could not drop their price as low as someone who had a house that maybe had no mortgage that simply had to sell it. So as we see these prices starting to go up again, we're starting to see this gap close, but not by much. We can see that the housing credit caused a nice closure, but it's continued to widen here. What we want to see is we want to see these new home sales, as the inventory continues to drop, to start to go up, and we'll see the existing home sales potentially start to go down, and we'll see this gap close. As we can see, it's not only new home inventory, but existing home inventory has continued to drop as well. We're down, we've basically had 13 straight months where home inventory has gone down. But while inventory is dropping, we've still continued to see house prices drop as well. And we break out distressed and non-distressed sales. We can see that both are moving up, but the blue line where we look at non-distressed sales is moving up now at a slightly faster pace. Again, positive for home prices over the next year. Part of that elevation of house prices is the fact that less overall sales are a percentage of distressed sales. We dropped to 29% of total house sales. That would be short sales and foreclosures combined. So we're below that peak where we got up to close to 38, 39%, and we're now into 30. We want to continue to see the total percentage of property sales dropping over time. This was originally published in the New York Times, but Dave Altig has said that when we look at house prices as a whole, we look at how out of line they are with overall, say, the Schiller Home Price Index, which you see there in the blue, and the building costs, which have continued to go up, we notice that the population line is coming up as well. So this is a real positive. In areas where population is continuing to rise, you can't help but have new homes being built, and home prices are more likely to be supported by this rising population over time. So all things being equal, the housing inventory continuing to drop and population continuing to rise will put a floor in housing. Is it completely this year? We think the floor is here, but will we see house prices go up? It may be another year or so before we really see that kicking in. And we're talking about the key dynamics for housing here. Unemployment, savings rates. Unemployment is a critical part of this. We've seen unemployment claims continuing to drop, and that is a positive for housing overall. So again, we look at the positives and the negatives. Again, another positive is that the overall delinquencies have continued to drop. Foreclosures has pretty much stabilized. People that are in foreclosure are not digging themselves out, but the number that are delinquent is going down. That'll help to reduce the number of future foreclosures. We have about 7.5% of mortgages are now delinquent, and about 4.13% are in foreclosure. Again, compare that to a national historical of around 1 to 1.25%. Basically, 1 in 10 homes that have a mortgage today are either delinquent or in foreclosure. So we have 11.7% combined that are either delinquent or they're in some kind of a foreclosure process. That's about 6 million homes in the U.S. today. So again, foreclosure starts we can see are going down, and the number of foreclosure sales are also going down 15% and 19% month over month. This is critical for housing to stabilize. We can see the overall trend here, the lower highs across the board, again, very positive. So let's kind of take a look at some of the things that might impact you at a local level. Overall, in April, we saw a slight decline to 75.7%, but overall, the sentiment has continued to be positive. Part of that has a lot to do with mortgage interest rates, as we actually see the 30-year fixed rate continue to trend down at around 3.98%, down from 3.99% the prior week. While the 30-year is just above its record, the 15-year actually hit a new all-time record low of 3.11%, lower than its prior all-time low March 8th of 2012. So we're continuing to see a very positive low interest rate environment supporting the market. This is a key driver in overall homeowner financial obligations. What we see here is that the total obligation for mortgage and consumer debt continues down. Consumer has sort of flattened out, but the mortgage debt, as people are taking advantage of HARP and refinancing, continues to go down. This is positive for discretionary cash flow. We need that extra cash flow to recover some of our wealth from the collapse of home equity, where we saw the average home equity per homeowner in the U.S. at close to $200,000, that includes all of the houses that were paid for, has now dropped closer to $78,000. So if you look at the home equity as a whole, the loss of home equity per homeowner is at about $122,000. Most of that loss was from falling home prices. Some of that is due to inflation and, again, homeowners taking equity out of their homes, but they'll need to replace that investing in other places. Unfortunately, as we'll see when we look at income and wages, they have not been able to maintain that higher savings rate that we saw right after the crash, where we spiked over 6%. We're back down now to 3.7%. That is near the lows of the 2009 recovery cycle. So people simply aren't able to save like they need to. Part of that reason that they're challenged is that if we look back since 2009, and we look at personal income overall since the crisis, personal income went up and has continued since 2010, 2011 to trend down. So the average hourly earnings, the disposable income, and personal income have all been trending down since the end of 2010. That means that the new jobs that are coming online are actually lower paying service-oriented jobs. They're not stimulating the middle to higher incomes that are more likely to spend that on housing and consumer goods. Now, one way equity can be increased is through various types of modifications, and one of the things we've seen is that lenders are more likely now to simply do principal reduction or principal deferral. Deferral meaning you can pay us in the future when you sell the property, but for now we're going to take some of that principal away so your payment goes down. Or, as Bank of America recently sent out close to $5 billion worth of notes to their clients saying we'll reduce your principal by up to $150,000. We can see the term extension has been going down. Rate reductions are going down. That means that there are fewer of those being used. Banks are just referring and considering just an outright principal reduction now as a way to help to stabilize their housing portfolio. Now, people are staying in homes longer. We remember previously 5.7 years and 7.2 years. Now we're showing an average of between 8 and 10 years as the average tenure in a home. Much of this has to do with the fact that people aren't unable to sell, and they're taking them longer and longer to sell their properties. So we see that people with lower income have a higher tenure. People with higher income are more mobile, but still we are seeing an increase from that 7.2 to close to an average of 9 years. We also see that when they do go to sell that home, being in that home selling process for less than a month is now by a quarter of Americans, but we can see that the majority of Americans are spending anywhere from 5 to 6 months or more if they can sell their house without a loss. That doesn't mean it's a bad time to buy a house. We actually see that there are many factors right now that make buying a house very positive. From the National Association of Realtors, we see, again, interest rates at an all-time low. we see that the median sales price of a single-family home is also continuing to decline. We see that the overall median family income has stabilized and has not dropped as much as was expected. We see that the mortgage payment as a percentage of income is actually at a historical low, meaning it's actually getting cheaper to buy than rent in many markets. And we look at mortgage principal and interest overall to buy a median-priced home with a 20% down payment. We can see that has also dropped dramatically in the last few months or years. So buying a home doesn't look so bad. We are seeing that the majority of Americans, as we mentioned in an earlier slide, that are renting in either large apartments or small apartment buildings. Those vacancy rates continue to go down. As we see vacancies go down, we see apartment owners more confident in raising those rents. 51%, the blue line there, raising rents versus 11% lowering rents. As rents go up, that continues to increase that gap of people that think, now may be a good time to buy. Another positive for housing. Those who are simply buying with cash continue to go up, a lot of that being investment properties and higher net worth buyers, but we see we're back up close to that peak from 2011 of cash buyers. It's interesting to look at the median house price in 2000, which was $143. 2005 jumped to $219. 2011, we're back down to around $166. What's really fascinating is the qualifying income to buy that house has gone from $40,000 up to $50,000 and down to about $33,000. So overall, house prices are continuing to be very affordable, and a lot of people are picking these up at fire sales, making cash sales over a third of all sales right now in the U.S. So that does it for this series. As we can see here from the key takeaways, mixed signs, again a positive base. It's just going to take some time.